Okay, so if we're really going to get a handle on where the economy is headed by 2026, we need a better way to think about it. So for a minute, let's just forget all the spreadsheets, the charts, the endless graphs. We're going to use a completely different kind of map.
Right. I want you to picture the economy as this enormous ship. It could be a cruise liner, it could be a battleship, it doesn't matter. What matters is that it's huge. It has this incredible momentum, and, it takes a very long time to change course, no matter who thinks they're at the helm.
And that is the billion-dollar question we're tackling today. Because there isn't just one storm cloud on the horizon. We're talking about multiple forces. You've got tech tsunamis, geopolitical crosswinds, and this thick fog of financial deadlines. And they are all converging. So, if you're an investor, figuring out how to navigate this isn't just, a good idea, it is absolutely essential.
So, before we can even think about sailing through the storm, we have to understand our own ship. What's actually powering the engines? And how do we read the complicated waters it's sailing in? When you boil it all down, it really comes down to two different ways of thinking, two competing philosophies for how to steer this thing.
So on the one hand, you've got what's called fundamental analysis. Using our metaphor, this is like being an engineer down in the engine room. You're checking the cargo hold, you're looking at the real, tangible stuff, company earnings, demographics, government policy. You're focused on the long-term health of the ship. But then on the other hand, there's technical analysis. This is like being the navigator up on the deck. You're not worried about the engine right now. You're reading the immediate waves, the wind, the chart patterns, all to predict the very next move. You really need both perspectives to get the full picture of where this ship is going.
All right, let's talk about the first giant wave that's about to hit our ship. It is a full-blown tech tsunami, but probably not in the way you're thinking. See, this isn't just about software and lines of code. This is a deeply, surprisingly physical revolution.
Haha, this quote just perfectly sums up the old way of doing things. For decades, a lot of the products we use saw these tiny, predictable improvements. But AI? AI isn't about making slightly better toilet paper. It is an exponential leap forward, and it demands a physical build-out on a scale we really haven't seen in generations.
And this number right here, this gives you a sense of the sheer physical scale of what's happening. We're talking about a nearly 37% jump in server spending alone. And that's not just some abstract number. That's real racks of hardware going into massive data centers, all part of this multi-trillion-dollar global project. At the end of the day, AI lives on actual, physical hardware.
And this leads us to a really crucial concept: physical capital deepening. To make all this AI stuff work, we need this whole three-tier system. You need the massive cloud data centers for training the models, then you need local on-premise servers to run them cost-effectively, and you need devices on the edge for instant, real-time responses. This isn't just a software update, people. This is a massive industrial project.
So think about it like this. If you want to invest in a gold rush, you don't always buy the gold miners. A lot of times, you buy the companies selling the picks and shovels. We're talking about the businesses that handle thermal management, because these data centers get insanely hot. The companies that build the high-density networks to move all that data around. The firms that are physically out there deploying the infrastructure. And, maybe most critically, the power grids and utilities that have to somehow fuel this entire revolution.
But wait, this huge demand for physical infrastructure isn't just coming from AI. The whole world of digital assets, crypto, it has its own enormous and, frankly, often overlooked physical appetite.
I mean, just look at some of these hidden costs. The Bitcoin network, by itself, uses as much electricity as the entire country of Sweden. That's insane. And the materials for batteries and hardware, they require unbelievable amounts of water and whole new kinds of specialized factories. This tech wave is physical, it's resource-intensive, and it is putting a strain on our industrial and energy infrastructure like never before.
Okay, so we've got this massive tech wave hitting the US economy. But at the exact same time, we're sailing through these totally unpredictable geopolitical crosswinds. These are the external forces that can just knock the ship off course in a heartbeat. Let's look at a perfect and pretty scary example. This is the Strait of Hormuz. At its narrowest point, it's only about 33 kilometers wide, but nearly a third of all oil that moves by sea passes through this little channel every single day. It is the absolute definition of a global choke point, and its stability, well, let's just say it's not guaranteed. So what would happen if some kind of conflict just shut this choke point down for 1 month? Just one. Well, even with other routes, the analysis suggests the global oil supply could drop by nearly 10%,
And prices, they could surge well into the triple digits. An event like that would send shockwaves through the entire global economy, affecting everything from how much it costs to ship goods to what you pay for gas.
But look, these crosswinds aren't just about military conflicts and oil tankers. Economic policies, things like trade wars and tariffs, they create their own kind of friction, and you can feel the impact of that directly in your own wallet. This number is just staggering. If the trade war with China heats up again, it could cost the average American household an extra $4,700 a year. That is not some abstract economic theory. That is a direct hit to your family's budget. It affects the price of everything from the phone in your pocket to the clothes on your back.
So we've talked about the tech tsunami and the geopolitical winds. Well, now our ship is sailing directly into a really thick fog bank, and it seems to be centered right on the year 2026. This is the point where multiple pressures all look like they're set to converge and peak at the exact same time. I mean, just look at how these different forces are stacking up. On January 1st, a new global crypto tax framework kicks in, which basically ends the whole era of hiding assets offshore. Then, by August, the EU's massive AI Act becomes law, creating this major regulatory split with the US. And then, hanging over all of it, is what experts are calling a $1.8 trillion wall of maturity. It's a colossal amount of commercial real estate debt, taken out when interest rates were basically zero, that now has to be refinanced at today's much, much higher rates. Any one of these things is a huge deal. Together, they create a period of extreme uncertainty.
Okay, wow. So we've mapped out the storm. The question is, how do we navigate it, right? The goal isn't just to ride it out. It's to actually take the helm and maybe even use these forces to our advantage. And that starts with changing how we think about some fundamental things, especially debt. You know, we're all taught that all debt is bad. Just fear it, get rid of it. But that's a huge misunderstanding. The key is knowing the difference between bad debt, which is money you borrow for stuff that loses value, like a new car or credit card debt, and good debt. Good debt is a completely different animal. It's money you borrow to buy an asset that actually generates income, like a rental property where your tenants are paying off the mortgage for you. In that case, the debt isn't making you poor. It's a tool that's actively making you wealthier. And the BRRR method is just a really powerful system for putting that good debt to work. So here's how it goes. You buy a property that needs some work. You rehab it. You fix it up, forcing its value to go up. You rent it out, creating a nice steady income stream. Then, and this is the key step, you refinance based on that new, higher value, and you pull your original investment right back out tax-free. And finally, you repeat the whole process with the next property. It's brilliant because your money is never just sitting there trapped. It's constantly out there acquiring new assets for you. So when you look at the whole toolkit, you start to see these clear options. You could go for broad exposure to a huge trend like AI, using an ETF like VGT. Simple, diversified. Or you could use that picks and shovels approach we talked about, targeting a critical company like Arista. Or you can apply leverage to real assets using a system like the Burr method. Each strategy has a different risk profile for sure, but they're all proactive ways to actually navigate the storm instead of just getting tossed around by it. Now, we have to be realistic here. Navigating a storm means turbulence. The long-term trend of human ingenuity and progress, especially with tools like AI, is always up. It's almost always better to be long, to bet on growth. But that doesn't mean it's a smooth ride, not at all. You have to be prepared for some serious volatility, some steep, sudden drops along the way. That's just the price of admission. So, the USS Economy is heading into a really complex, really challenging couple of years. The waves are high, the wind is strong, and the fog is getting thick. The question is, are you just going to be a passenger, tossed around by forces you don't really understand? Or are you going to grab the navigation tools, understand the vessel, and take the helm yourself? The choice, really, is yours.